The resilience of the U.S. economy has surprised some, and it comes as the economic and financial gap with Europe continues to widen. Now, GDP growth and productivity levels are now much further ahead in the U.S., something which my next guest says is a once-in-a-generation phenomenon. Well, Daniel Pinto is chairman and chief executive of Stanhope Capital, an asset management firm he started in 2004 with more than $41 billion of assets under management. So, Daniel, as always, thank you so much for joining us, and welcome back to The Pulse. When you look at what you're expecting from the Fed, I mean, it's a little bit of an outlier call. You're expecting the Fed to cut quicker than the market is pricing. Would they cut because there's a slowdown or because of inflation is under control?
My first comment, Francine, is that who would have said that watching central bankers would have become as exciting as watching a thriller? We listen to each and every word. Look, my sense is that the U.S. economy is slowing down. It's still doing okay, but it is slowing down. Let's remember that the market was expecting 2.5% GDP growth for Q1. It came out at 1.6%, so it is slowing down. You have PMIs coming down, which is a sure sign that there is a slowdown. You have unemployment picking up a bit, still very low, but picking up a bit. And two more things, which in my view are very important. The first one is that saving rates in America have collapsed. Post-COVID, Americans had plenty of savings, and that sustained the economy for the last 2 years. Right now, they have 3.5% of savings, which is the lowest point in the last 10 or 15 years, which basically means that you no longer have this buffer in the form of the domestic consumer to support economic growth in the next few months. And I think the Fed knows that, and the Fed will cut rate, in my opinion, in September, probably twice.
So, Daniel, we all spoke to Jamie Dimon yesterday, and he was saying, look, it's the market makes it a given that we have a slowdown, that is a soft landing, and that's not a given. But is there the worst case scenario is that inflation actually stays up, and that these indicators come down? So, what does the Fed choose then, and what kind of economy are we left with?
I think the Fed will be under pressure for another reason, which is that let's remember that a year ago we had a banking crisis in the U.S. Yeah. We are not hearing anything about it anymore, but you have dozens of small regional banks in America that are exposed to real estate, are writing off loans, and the higher for longer phenomenon is having a direct impact on this second tier of the banking sector in America. And I think that the Fed will, in addition to the slowdown that I described, the Fed will very much be aware that if they keep rates at this high level, they may have another banking crisis on their hands, which obviously they would like to avoid.
But there's also a question of why the Fed is not pushing back against some of the market exuberance that we've seen. Do you see this as being problematic?
I don't think it is problematic. I mean, there is some exuberance in the market, but I don't think that we are in bubble territory. If you look at stocks in America, they are trading on multiples of about 20 times, which is higher than the average. But if you strip out the technology sector and the Magnificent Seven, the valuation levels in the US are in line with the average of the last 25 years. You don't have a bubble in the equity market in the US. I don't believe so.
Daniel, I know there are some charts actually that you look at, which we love showing because it gives us a glimpse into kind of what kind of template you look at to look at growth and valuations. There's a mismatch between the US and Europe. I mean, if you're expecting actually the US to slow down not significantly, but enough to pull forward expectations of a cut, where do you see the biggest play? Do you get into European stocks?
So European stocks are cheap at the moment as compared to the US. In fact, you are at the point where the discount between Europe and the US is at its highest in the last probably 20 years. You basically have a 35% discount between the valuation of European stocks and the valuation of US stocks. It makes a certain segments of the European equity markets attractive. And it could be, and we've seen that in the last few months, that for a short period of time, European equities could outperform the US. But for any long-term investor, I would recommend having the majority of their exposure to US stocks for reasons that have to do both with the US economy that has decoupled from the European economy, and as a result as well of market dynamics, which are much better in the US than in Europe. So short term, yes, European equities attractive. Long term, I think investors should keep the vast majority of their equity exposure into the US.
I mean, this is actually the chart of the day that we're just showing, one of the charts that you're looking at. I mean, does this explain why certain companies, I mean, we were talking with actually the chief executive of Total Energy just on Tuesday, but other companies would look at a listing in the US, and does that even make sense for big European companies?
They would, and it should worry a lot of politicians in Europe. When you hear Total Energy, which is kind of a national champion for France, saying we would like to move to list in the US, it is a shock. When you hear Shell saying the same thing, it is a shock. And the reason why they are saying that is very simple. The capital markets in the US are so much deeper that they get better valuations. You cannot blame them for saying, I'm working for my shareholders, and with shareholders in mind, our interest is to list in the US. And the reason why the capital markets are so much deeper is that they have a pension system that drives savings into the real economy, whereas in Europe, in most countries, we have a pension system that is still public, and is not driving savings into the productive economy. And that's a major issue. Just take the case of the UK. 25 years ago, pension funds in the UK were investing 45% of their portfolios into UK equities. Now it is 4%, 5%. And that has a massive impact on appetite for equities overall, and therefore valuations. And that is something that CEOs across the UK and across Europe have in mind.
I mean, what should be the priorities of politicians and policymakers in Europe to be more competitive and keep the good companies here?
So most of the savings in Europe are in the hands of insurance companies and pension funds. And right now, this capital is locked up, unable to deploy itself in private equity, public equities, etc. And that's a major difference with what's going on in the US. And I think it is hampering not just valuations, but the capacity of these companies to invest. And that's really not just an economic issue, it's a political issue as well. So I think the priority for politicians right now should be to address this very issue. Make sure that insurance companies have more leeway to invest in private equity and public equity. Make sure that pension funds are not just focused on investing in bonds, which are not necessarily helping the economy at large, but investing more in small and mid-cap companies and in large companies. That should be the priority.
Yeah, it's not easy because it goes really to the heart of like risk-taking. But talk to me a little bit about what you're seeing in the pipeline. Are there more IPOs or is there more M&A deal? Is it waking up?
So clearly, after 18 months, 2 years of pretty much a standstill in the IPO market.
Sleeping Beauty.
Absolutely. And private equity funds not doing much, frankly. What you see now is private equity funds being very keen to deploy more and sellers more open to selling. So you'll see deal flow picking up, which is great news. The IPO market is slowly opening up, more in the US than in Europe. I was pleased to see that the Chinese company Shine is contemplating doing an IPO in London as opposed to the US. It's a good sign, but sadly I think we have to do not a done deal, and we need to do much, much more to make London more attractive. But clearly the trend is going in the right direction in terms of IPOs and deals.
I mean, does it make a difference who comes into power in terms of businesses right now, or do you see both parties?
In the UK?
In the UK, pretty much in the middle.
I think the two sides want to reform London and the city in general. The question is whether they've been talking about it for a while. Not much has happened. The question is whether any new government, probably from Labour, would actually implement the reforms that are absolutely necessary. I hope they will. They seem to be more market-friendly than people expected. Let's see.
What do you do with gold right now? So it's a play against everything, but it's also, I guess, there's movements maybe from other countries to sell treasuries and buy gold.
So there is something structural happening in the gold market, but beyond the gold market, in trade in general and currencies in general. You've seen the price of gold going up dramatically over the last, I would say, 12 months as a result of central banks buying more and more gold. And the biggest buyers of gold have been probably the Chinese. And the reason why they are buying more gold is that they don't want to be in the position of the Russian central bank, which, given what was going on in Ukraine, ended up being sanctioned and ended up having their reserves frozen by the US. The Chinese have trillions of reserves. The last thing they want is to, hear one morning that the Federal Reserve had decided to block this money. So they buy more and more gold. The Indian central bank is doing the same, and that is what's sustaining the gold market. Beyond that, I think we should read behind, the rise of gold, an increasing risk of currency wars and an increasing risk of trade wars.
Is that your biggest
Sanctions,
concern?
Tariffs. That would be my biggest concern for the next 12, 18 months. You heard President Biden announcing last week very high tariffs on electric vehicles, 100% tariffs on microchips made in China. And then you heard Trump basically saying, 100% is not enough, it should be 200%. So that rhetoric is giving you the direction of travel. Direction of travel is more and more trade tension. And trade tension and tariffs are a very, very bad thing for everyone. So we should be very careful about that.
And possibly inflationary. Danielle, thank you so much, as always, for joining us. Danielle Pinto there, the Chairman and Chief Executive of Stanhope Capital.